In the realm of global economics, few issues generate as much concern and debate as the United States debt ceiling. Now, like dark clouds gathering on the horizon, this recurring fiscal dilemma casts a looming shadow over the nation's financial stability, political landscape, and the global standing as well. Now, in this episode of the Third Empire, we will dive deeper to understand what crisis is the US having in front of themselves right now. While we talk about that, let's also look at India's industrial landscape, which witnessed some deceleration in growth as the Index of Industrial Production, or the IIP, recorded a modest expansion of only 1.1% in March 2023. Now, this slowdown in IIP growth is a departure from the previous positive momentum and has significant implications for the country's economy. In this episode, we will also dive into the details and try to understand the complex factors affecting India's industrial production. You're watching Informed Investor, the Third Empire, an initiative by Research and Ranking. Let's begin. Now, as we already know it, every country and its government has to allocate and spend money on various purposes such as public infrastructure, education, healthcare, defense, social welfare programs, and other public goods and services. Now, it includes both recurring expenses such as salaries and maintenance, as well as capital expenses such as the long-term investments. Now, these payments are made from the revenue that they generate through the different taxes imposed, fees, and incomes from other sources. But there is almost never a clear-cut match between the expenses and the income, of course. Now, to tackle this issue, the government borrows money to cover the outstanding balance of expenses by selling marketable securities such as the treasury bonds, T-bills, notes, floating rate notes, and treasury inflation-protected securities. So, well, talking about the US has carried debt on its books since its inception. Over the past 100 years, the US federal debt has increased from around $400 billion in 1922 to $30.93 trillion in 2022. Notably, recent events which triggered large spikes in the debt include the Afghanistan and the Iraq wars, the 2008 Great Recession, and the COVID-19 pandemic. From FY19 to FY21, spending increased by almost 50%, largely due to the COVID-19 pandemic. Tax cuts, stimulus programs, increased government spending, and the decreased tax revenue caused by widespread unemployment generally account for sharp rises in the national debt. Now, comparing a country's debt to its gross domestic product, or the GDP, reveals the country's ability to pay back its debt. Now, this ratio is considered a better indicator of the country's fiscal situation than just the national debt number standalone, because it shows the burden of debt relative to the country's total economic output and therefore its ability to repay it. Now, the US debt to GDP ratio surpassed 100% in 2013 when both the debt and the GDP were approximately at $16.7 trillion. Now, in the current scenario as on date, the debt to GDP is roughly around 120%. Now, the US is facing an issue where it could start to run out of money within weeks and also breach the debt ceiling limit, which could get very tricky and reach to a so-called X date, which implies that it can no longer pay its own bills. So, what is the US debt ceiling? Now, to talk about the US debt ceiling, it is also known as the debt limit. Now, this is the law that limits the amount of money that the government can borrow to pay its bills or meet its financial obligations. Now, this includes paying the federal employees, the military, the Social Security and Medicare, as well as the interest on the national debt and the tax refunds as well. Historically, whenever the US approached its debt ceiling limit, the government faced the risk of defaulting on its financial obligations, and if the Congress failed to raise or suspend the limit, a default would have severe consequences, including a downgrade of the country's credit rating, skyrocketing borrowing costs, and a loss of the confidence in the US dollar, which is the global reserve currency. Now, these outcomes could trigger a financial crisis both domestically and globally as well. Now, the debt ceiling is currently set at $31.381 trillion. Now, this limit was breached on 19th January. Since then, the Treasury Department, which is the Finance Ministry of the US, has taken extraordinary measures to curb some government investments in order to be able to continue paying the bills. Now, the government has some ready cash at any point in time, but this cash and the extraordinary measures are expected to run out by the 1st of June. Now, when was the last time that the debt ceiling was raised, you may ask? In 2021, they raised the limit by an additional $2.5 trillion, which set the bar at $31.4 trillion, which hit the debt limit as of January 19, 2023. Now, the US have breached the limit several times and have constantly raised the limit as and when required over the last 100 years. In fact, the debt ceiling was raised approximately 74 to 78 times from March of 1962 to May of 2011. Now, as done previously, it's usually a formality to just raise the limit as needed, but this time, due to the political tiff between the Republicans and the Democrats, there isn't any clear direction to agree on the terms. So what happens if the debt ceiling is not raised? Technically, this has never happened ever, but if done, it could cause major economic damage. The government would be in a position where it would be no longer be able to pay the salaries of federal and military employees and social security checks. This includes the payments that the millions of pensioners in the US rely upon. Also, companies and charities that count on the government funds would be in a fix. Additionally, the US has never defaulted on its debt, and that's the reason why US Treasury bonds are viewed as safe investments and used by banks to hedge any counteract risky investments. But if the government stops making interest payments on its debts, it would put the entire country into a debt default. Now, a debt default would throw both the domestic and the global economies into a major chaos. Now, according to Moody's Analytics, it would lead to a similar situation like the 2008 financial crisis, with spiking interest rates and stock prices plunging. Apparently, stock prices would fall by almost a fifth and the economy would contract more than 4%, leading to the loss of more than 7 million jobs. It would aggravate the risk of recession and credit downgrade. Given that this is highly unlikely, the US government would soon find out a way before June 1st. So what's next, you may ask? The US government can raise the debt ceiling or suspend it after getting approval and a majority vote in both the houses of the US Congress. But as is the case right now, what if there is no clear agreement? Is there any last resort? Well, yes, there is. The 14th Amendment. Now, as we approach closer to the said X date, the option open to the government and the last resort would be to invoke the 14th Amendment. Now, the 14th Amendment states that the validity of the public debt of the United States authorized by law, including debts incurred for payments of pensions and bounties for services in suppressing insurrection of rebellion, shall not be questioned. Now, this implies that Joe Biden has the power to authorize the Treasury to repay the US debts, even if there is no agreement to raise the debt ceiling. But this would be the last resort and would likely get caught up in the courts and create a constitutional crisis. Given that this is highly unlikely, the US government would soon find out a way before 1st June. But it's important to note that the US debt ceiling crisis is a complex and multifaceted issue with far-reaching consequences, and it demands the attention and cooperation of the leaders from all sides to ensure the nation's financial stability, preserve its global standing, and safeguard the well-being of its citizens. Now let's discuss an important economic indicator that reflects the level of industrial activity within the Indian economy. The Index of Industrial Production, or IIP as it's commonly known, is used to monitor industrial activity across various sectors such as manufacturing, mining, and electricity. Now in March, India's industrial output experienced a growth rate of 1.1%, which is the slowest pace seen in the past 5 months. Now, the industrial growth rate for February measured by the IIP has been revised upward from 5.6% to 5.8%. However, the March IIP growth figure of 1.1% falls significantly below the expected consensus estimate of 3.2%. Now, looking at the overall performance, industrial production recorded a growth rate of 5.1% for the entire fiscal of FY23, compared to 11.4% in fiscal 2022. Now, the expectation of a moderation in IIP growth for March was indicated by the performance of the core sector, which holds a weight of nearly 40% in the IIP. Now, the core sector's growth rate declined to 3.5% in March, down from 7.2% previously. Now, when we look at segment-wide performance in March, the manufacturing sector, which contributes more than three-fourths of the IIP, experienced a minimal year-on-year growth of only 0.5% compared to the 5.6% increase seen in February. Among the various categories within manufacturing, 13 out of 23 categories observed a decline in output in March compared to the same month of the previous year. Sectors heavily reliant on exports such as textiles, wearing apparel, leather, and related products have consistently faced challenges with their output contracting year on year. Electricity production declined by 1.6% in March, contrasting with an 8.2% growth in February. However, in a sequential comparison with February, manufacturing output showed a notable increase of 6.4%, while electricity production saw an 8% rise. Now, the mining sector, the third compound of the IIP, witnessed a year-on-year output growth of 6.8% and a significant month-on-month increase of 19.3%. Now, when we compare it to the pre-COVID levels, it does show that India's industrial activity is absolutely resilient. The IIP rose by 4.4% in March 2023 compared to the relative pre-COVID month of March 2019, benefiting from a double-digit expansion in electricity, which is at 17.4%, and mining, which is at 16.2%, followed by muted growth in manufacturing at 1% compared to the pre-COVID levels. Now, the industrial sector is likely to benefit in the coming months from a decline in the global commodity prices, which will lower the input costs. Now, the centre has demonstrated a strong commitment towards boosting capex in the economy. The centre's strong capex focus and improving investment intent by the private sector are positives for the growth in the IIP. The other high-frequency indicators such as auto sales, GST collections for the month of March all point to a strong growth. However, the weakening of external demand and uncertain global environment could be major challenges for the momentum in industrial activity. As a result, maintaining domestic demands becomes even more crucial. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.